Good afternoon, Dr. Seetharaman.
Good afternoon.
We are talking today on the US Federal Reserve meeting.
Okay.
The Fed meeting happened last week, and in this regard, we would like to hear from you on this.
Well, Fed Open Committee meet has been having profound implication in the overall financial markets. You know it. There are four factors which are driving the indicators. One is the purchasing power. That's moving up, there's no issue. Housing market, which is slowed down in terms of overall recovery. Inflation has not taken momentum, so the interest rates will be still for a considerable period of time will be between 0 to 0.25%. And again, unemployment, labor market, that's still costing between 6.5 to 6.7. And the purchasing power of the people has improved. So unemployment, housing, overall growth, if you look at it, it's all a function of all these factors. And when it comes to the overall Fed pronouncement, all these factors intertwine to each other, and that will have clear economic impact in substance.
What are the key economic indicators focused by Federal Reserve?
Federal Reserve wants 2% inflation. They want to bring down the unemployment to less than 6.5%. That has to happen. Inflation has to propel so that the overall economic momentum comes in. That's not happening as much as they wanted. A policy constraint in terms of development expenditure is also not happening. The development expenditure has to have restraint policy at one side. Now it's not up or down, it stands still. You need more development expenditure by policymakers, more decision making in terms of government drive, and that's standstill. That's the inference we have within the overall impact.
What are the tapering measures announced by the Federal Reserve?
It was $65 billion per month. Now, one is the treasury, another one is asset-backed mortgage securities. Now, 35 to 30 has been reduced. Again, 30 to 25 has been reduced in terms of treasury securities. Now, that is 55, 10 billion less than the original program of quantitative easing. That cannot be altered unless you see a definite pickup in the overall economy. It means unemployment has to come down less than 6.5%. The inflation has to go up, nearing it to reach towards 2%. And again, housing market has to really have a robust recovery. Purchasing power, even though it's improving, it can be further improvised. So all these factors are going to drive. Meanwhile, the government expenditure, which is going to give growth and employment, will be a free flow. All these factors, unless it's going to drive the change, you will not be cutting down the bond buyback program further.
What is the criteria you think for keeping interest rates?
Inflation. Inflation is the source. You have to look at what is the inflation trends. Interest rate as on date is falling between 0 to 0.25. If the purchasing power improves, if there's more money buying power comes in, the market will get inflated. If there's a demand chasing few supplies, whether it is housing, whether it is fuel, whether it is household goods, the more and more purchasing power parity will get inflated. The overall reflection of the economic momentum and the interest rates can be lifted on the higher side. That's not happening, and that's going to be a long wait as I see, and that's what the impression the Federal Reserve chairperson has created. It is going to be a long wait, maybe 2015, the second quarter or so is the expected targeted timeline.
What happened to the forward guidance from Federal Reserve?
we look at the past, nothing significant has happened. It stands still, but it's improving. We get a feeling America is recovering. The forward guidance, the growth has to be about 3%. Unemployment should be 6%. So development expenditure has to recalibrate the growth. And inflation has to move up, nearing 2%. And that's not visible. We foresee the growth may touch 2.75. We foresee the interest rate will not change for the next 1 year at least. We foresee housing market has to be stimulated further. So interest rate has to be kept, housing mortgages has to go up, more and more banks lending has to take place. That's unlikely seen in the short term.
Thank you, Dr. Seetharaman, for this update.